They waited until you were asleep. They waited until the volume was thin, the lights in New York were off, and the Western world was distracted by the final preparations for New Year's Eve. And then, with a single bureaucratic stroke of a pen in Beijing, they effectively ended the 50-year era of Western dominance over the price of silver. We are waking up this morning to a new world, a world where the price you see on your screen is no longer a reference point, but a historical artifact. It is Wednesday, December 31st, 2025, the last day of the year. But in China, it is already the future. And in that future, the export gate has just slammed shut. While the algorithm-driven spot price in the West was drifting aimlessly overnight, a massive, coordinated seizure of physical inventory occurred on the Shanghai Gold Exchange, SGE. We are calling this event the Corner. It wasn't a raid, it wasn't a panic buy. It was a methodical, state-sponsored absorption of every available ounce of deliverable silver in the Asian theater. Intelligence reports, confirmed by the sudden force majeure notices hitting the inboxes of industrial buyers in London this morning, indicate that the People's Republic of China has officially reclassified silver. As of midnight, Shanghai time, silver is no longer an industrial commodity subject to free trade. It is now designated a strategic defense asset, placing it under the direct control of the State Council. Do you understand what just happened? For decades, the global silver market relied on a mechanism called the swing. When the West ran low on silver, metal flowed from the massive refining capacity of the East. When the COMEX was being squeezed, the bullion banks could lease metal from Shanghai to flood the market and suppress the price. It was a safety valve. It was the plumbing that kept the manipulation game alive. Last night, China welded that valve shut. The export licensing system that we warned you about, the one the mainstream media said was unlikely to be strictly enforced, has been activated with maximum severity. Not a single bar of 1,000-ounce commercial silver is allowed to leave Chinese ports as of this morning. But they didn't just stop the exports. That would have been bad enough. They went one step further. They activated a domestic vacuum. While you slept, the state-owned banks of China, the ICBC, the Bank of China, the construction giants, executed a synchronized limit-up bid for physical metal. They didn't buy paper futures. They didn't buy ETFs. They bought the warrants. They bought the legal title to the metal sitting in the warehouses. And here is the terrifying part for the Western banking cartel. They bought it at a premium that the West cannot match. Right now, there's a ghost price on the COMEX of roughly $80. It looks high. It looks like a bubble. But in Shanghai, the real price, the price to actually own the metal, is trading at a $12 premium over that. This is the arb gap from hell. Normally, arbitrage traders would see this gap and rush to sell silver in Shanghai and buy it in New York, equalizing the price. But they can't, because they can't get the silver out of Shanghai once they sell it. The trap has snapped shut. So what does this mean for you, sitting here on the final morning of 2025? It means you are looking at a zombie market. The COMEX is still trading. The lights are still on. The ticker is still moving. But the metal backing those trades is gone. The connection between the paper price and the physical reality was severed while you were in REM sleep. The banks in London know this. That is why, if you look closely at the pre-market data, you see something terrifying. There were lease rates for silver. The cost to borrow physical metal for immediate delivery just went vertical. They didn't just double, they went parabolic. The banks are scrambling. They're frantic. They know that in less than 24 hours, the Basel IV regulations kick in. We will cover this in part 3. And they are suddenly caught in a delivery default scenario of their own making. They thought they had time. They thought they could manage the transition into 2026. They thought China would play by the old rules. They were wrong. China just cornered the market on the final day of the year, effectively taking the rest of the world hostage. The ransom note hasn't been read aloud yet, but we know what it says. If you want the metal for your missiles, your solar panels, and your batteries, you will pay our price. And you will pay in gold, not dollars. The heist is complete. Now the panic begins. Are you ready to see exactly how they drained the pool without anyone noticing? To understand the brilliance of the trap that was sprung last night, you have to look at the inventory shell game that has been playing out for the last 6 months. The Western banks were playing checkers, moving paper receipts back and forth to hide their insolvency. China was playing 4D chess with physical bars. The mechanism of the corner relies on a specific weakness in the global supply chain, the refining bottleneck. Most people don't realize that while silver is mined all over the world, in Mexico, Peru, Poland, a massive percentage of it is refined in China. The raw ore, concentrate, is shipped to Chinese smelters, processed into 999 fine industrial bars, and then re-exported to the West to fill the vaults of the LBMA and the COMEX. For years, this flow was constant. It was the heartbeat of the market. But starting in October, that heartbeat developed an arrhythmia. We noticed it in the shipping manifests. The ships leaving Shanghai were lighter. The loadout queues were getting longer. The excuses from the refineries were getting more creative. Maintenance issues, power rationing, environmental audits. We now know these were lies. They were stalling. While the West was being told that supply was just delayed, China was quietly redirecting that refined silver into a new network of shadow warehouses. These are non-exchange bonded zones located near the major manufacturing hubs of Shenzhen and Guangdong. Last night, the trap was finalized. The strategic retention order issued by Beijing effectively nationalized this shadow inventory. It stated that any silver suitable for high technology application, which is basically all investment grade silver, must be offered to domestic industries first before an export license can even be considered. And who are these domestic industries? They are the entities we warned you about in previous reports. The solar giants, like LONGi Green Energy, and the battery manufacturers, like KTL. These companies have an insatiable hunger for silver. The new solar bomb technology, TOPCon and HJT cells, uses 50% to 80% more silver than previous generations. We told you this was coming. We told you the demand was inelastic. Last night, the Chinese government told these companies, fill your boots. And they did. In a matter of hours, the Shanghai Futures Exchange, SHFE inventory, which was already sitting at a decade low of roughly 700 tons, was raided. But it wasn't just the exchange metal. The shadow inventory was simultaneously locked down via long-term offtake agreements signed under duress guidance from the state. The result is a vacuum that is now sucking the rest of the world dry. Think about the physics of this. The global silver market runs on a deficit. We consume more than we mine. For the last 5 years, that deficit was filled by above-ground stockpiles. China was the stockpile. Now, China is a net buyer. This reverses the polarity of the entire global flow. Instead of silver flowing from east to west to suppress the price, silver is now being vacuumed from west to east to feed the industrial beast. And the Western banks are standing there with their pants down. They are short millions of ounces on the COMEX. They were counting on that Chinese refined bars to arrive in January to settle their accounts. Those bars are not coming. The ships are not sailing. The sold-out signs you're seeing at bullion dealers this morning, that isn't retail panic yet. That is the wholesale supply chain freezing up because the master tap has been turned off. The corner isn't about money, it's about energy. China knows that the future is solar and electric. They know silver is the conductor of that future. By cornering the physical market, they haven't just bought a metal. They have bought the keys to the 21st century economy. And they did it 24 hours before the Western banking system faces its biggest regulatory test in history. Are you ready to see why tomorrow, January 1st, is the day the banks effectively die? We have arrived at the kill shot. The reason why this Chinese maneuver was timed for this specific night, the final night of 2025. It wasn't random. It was calculated to inflict maximum damage on the Western financial system at its most vulnerable moment. Tomorrow is January 1st, 2026. To the average person, it's just New Year's Day. But to a bank risk officer, it is doomsday. This is the date that the Basel IV banking regulations are fully, irrevocably implemented globally. Specifically, we are talking about the Net Stable Funding Ratio, NSFR. We have spoken about this before, but you need to understand it in the context of what China just did. Under the old rules, Basel III, banks could hold unallocated silver, paper promises with no specific bars attached, and count it as an asset. It was good as gold. That ends tomorrow. Under the NSFR, unallocated gold and silver are reclassified. They are no longer considered high-quality liquid assets. They are considered risky liabilities. To hold these unallocated positions on their books after midnight tonight, the banks must post 85% required stable funding, RSF. In plain English, they have to put up real cash reserves to back their paper bets. This makes the paper suppression game prohibitively expensive. It destroys the profit margin of the short sellers. So the banks had a plan. Their plan was to spend the month of December crashing the price, which they tried, and physically acquiring metal to convert their unallocated positions into allocated positions, which are exempt from the penalty. If they could get physical metal into their vaults by December 31st, they would be safe. Allocated metal is considered a Tier 1 asset. No penalty. They were counting on the flow from China to save them. They were counting on the end-of-year deliveries from the Shanghai refineries to turn their toxic paper into valid metal. But China knew this. By locking the export gate last night, by cornering the physical market before the Basel IV deadline, China has denied the Western banks the collateral they desperately need to survive the audit. The banks are now trapped. They are holding massive short positions that turn into radioactive waste at midnight. They cannot get the physical metal to allocate them because China took it all. So what is their only option left? The force majeure. They are going to have to default. Not on everyone, but on the weak hands. In the next 24 hours, watch for the cash settlement emails. If you hold a paper position, an ETF, or an unallocated pool account, you're about to get a notification. They will tell you that due to extraordinary market conditions, they are closing your position and sending you cash. They will pay you out at the last traded price, maybe $80, maybe $75 if they manage to spoof it down. But they will not give you the metal. They can't. They don't have it. They will strip you of your asset right before the price goes vertical. They will sacrifice the retail investor to save the institution. Basel IV was supposed to make the banks safer. Instead, combined with a Chinese lockout, it has created a liquidity black hole. The banks are naked, the tide has gone out, and the shark just swam into the shallow water. The corner is the trap. Basel IV is the spikes at the bottom of the pit, and the Western financial system just fell in. We have to talk about the emails, the notifications, the digital tap on the shoulder that is going to turn this theoretical crisis into a personal financial nightmare for millions of people in the next 12 hours. If Part 3 was about the banks trying to save themselves from the Basel IV regulators, Part 4 is about how they do it. And unfortunately, the how involves you. It involves a clause buried deep in the 60-page prospectus of every major silver ETF, every unallocated pool account, and every digital precious metals platform. It is a clause written in legalese so dense that 99% of investors have never read it. It is called the cash settlement provision, triggered by a force majeure event. Here's the scenario that the risk management algorithms at JP Morgan and BlackRock have modeled for today, December 31st, 2025. At some point before the markets close for the final time this year, the Western banks are going to realize that the China corner, Part 1, is real. They are going to realize that the ships from Shanghai are not coming. They are going to realize that they have zero chance of physically backing their short positions before the Basel IV deadline at midnight. They will be facing a delivery default. In a free market, a delivery default means the price goes to infinity. If you sold something you don't have, you have to pay any price to get it. You have to bid $100, $200, $500 an ounce until someone sells. But the COMEX is not a free market. It is a managed casino. And the house does not like to lose, so instead of bidding the price up to infinity, they are going to declare a market disruption. We expect that within the next few hours, the major exchanges will announce that due to irregular supply chain constraints and geopolitical logistical halts, they are suspending physical delivery for the January contract. And then they will pull the trapdoor. They will invoke the cash settlement clause. This is the rug pull of the century. If you are holding an ETF like SLV, or if you have digital silver in a banking app, you do not own silver, you own a claim on a trust. And that trust has the legal right to close your position and pay you in fiat currency if they determine that physical delivery is impracticable. Here is the horror of the math. They will cash you out at the last traded price on the COMEX. Remember the smokescreen crash we discussed in Part 1? The banks have spent the last 24 hours spoofing the paper price down to $75 or $80. They will force you to sell at $80. They will deposit the digital dollars into your brokerage account. They will say, here's your money, you made a profit, go away. But while you are staring at your $80 settlement, the real price of silver, the price to actually buy a physical bar in Shanghai, Dubai, or on the black market, will be rocketing past $120. You will be cashed out of the asset class at the absolute bottom of its valuation, right before it reprices to reality. You will have the money, but you won't be able to buy the metal. The dealers will be sold out. The premiums will be 100%. You will be left holding a bag of depreciating fiat currency while the train leaves the station at Mach speed. This is not a conspiracy theory. This happened in the nickel market on the LME in 2022. They canceled billions of dollars in trades to save a Chinese tycoon. They changed the rules in the middle of the game. Today, on the eve of 2026, they are going to do it to the entire silver market. The banks are insolvent in metal terms. They cannot get the silver from China. So they are going to steal yours. They are going to liquidate the retail public to cover the hole in their own balance sheet. This is the soft default. It doesn't look like a bankruptcy. It looks like a glitch. It looks like a refund. But make no mistake, it is a confiscation of wealth. If you do not hold it in your hand, if you do not have the physical weight in your possession, you're standing on a trapdoor that is greased and ready to drop. Are you ready to see who is picking up the physical metal while the retail investors are getting liquidated? While the retail investor is being led to the slaughterhouse of cash settlement, a very different scene is playing out in the boardrooms of Silicon Valley and Seoul. We have to talk about the whales. Not the financial whales, not the hedge funds, but the industrial whales. Samsung, Tesla, Apple, Raytheon. For the last decade, these companies operated on a just-in-time inventory model. They believed the lie, They believed that the COMEX always had silver. They believed that if they needed 10 million ounces for a new battery line, they could just call a bullion bank in London and it would be delivered next week. But this morning, the phone lines to London are dead. The China corner has sent a shockwave of pure panic through the high-tech supply chain. These companies employ supply chain analysts who are far smarter than any Wall Street economist. They saw the strategic retention order from Beijing. They know what it means. It means that 80% of the world's refining capacity for industrial-grade silver is now offline for export. And here's the problem. You cannot build a solid-state battery without silver. You cannot build a solar panel without silver. You cannot build a Tomahawk missile guidance chip without silver. It is not a choice. It is a matter of physics. If Samsung cannot get the silver, they cannot ship the Galaxy S26. If Tesla cannot get the silver, the Cybertruck assembly line stops. Their stock prices would collapse. Their existence is threatened. So what are they doing right now while you sleep? They are bypassing the banks. We are seeing evidence of a massive industrial panic bid happening in the shadows. We are talking about direct mine-to-factory contracts being signed at prices that have nothing to do with the COMEX spot price. We have reports of a major Korean tech giant, likely Samsung, offering a 40% premium over spot to secure supply directly from miners in Mexico. They are not bidding $80. They are bidding $115. They are bidding $120. They don't care about the price. The cost of silver is a fraction of the cost of the final device. They care about availability. This is the vacuum effect we warned you about. The banks are trying to crash the paper price to settle with retail investors. Part 4. But the industrial giants are ripping the physical metal out of the system at huge premiums. This creates a bifurcated market. Price A, the screen. A manipulated illusion kept low by paper selling. Price B, the reality. A skyrocketing price paid by desperate corporations fighting for survival. The COMEX inventory is being drained from the back door. The registered category, the metal available for delivery, is vanishing. It's not going to investors. It's going into the furnaces of industry. It is being consumed, gone forever. In the next few hours, as the Basel IV deadline looms, this industrial buying panic is going to collide with the bank's inability to deliver. The banks are short, the industry is long and hungry, and the retail investor is stuck in the middle with a cash settlement notice. The ghost inventory is gone. The illusion of abundance is over. The industrial whales are eating the last of the plankton, and there is nothing left for the sharks in suits. Are you ready to see the final nail in the coffin? The group that has finally decided to switch sides? We have the Chinese government locking the gate. We have the Western banks defaulting on retail. We have the tech giants panic buying. But there is one final player that determines the fate of the world in 2026. The people who hold the shovel, the miners. For 40 years, the primary silver producers, the companies in Peru, Mexico, Poland, and Australia, have been the battered victims of the banking cartel. They dug the ore, took the risk, and sold their product at a price rigged by a computer in New York. They were price takers. But today, on the final day of 2025, they have become price makers. Intelligence from inside the mining sector confirms that a producer's revolt is underway. It started quietly in November, but it has gone full scale in the last 24 hours. The CEOs of the top primary silver miners have looked at the China corner. They have looked at the industrial panic bid, and they have done the math. Why would they sell their concentrate to a COMEX-approved refiner in the West for $80, the manipulated paper price, when Samsung is knocking on their door offering $115? Why would they ship their metal to London, where the banks use it to short the price down, when they can ship it to Shanghai or Seoul, where the price is allowed to rise? We are seeing a supply chain pivot. The shipping routes are changing. Ships that were scheduled to depart Manzanillo, Mexico, for Western ports are being remanifested. They are turning west. They are heading across the Pacific. The miners are effectively joining the China bloc. This is the nightmare scenario for the LBMA, London Bullion Market Association. The London vaults run on a flow. They need fresh bars arriving every week to replace the ones being withdrawn. If the miners stop selling to London, if they divert their production to the Asian industrial hub, the London vault goes empty, not in a year, in weeks, the miners. This is the zombie exchange phenomenon. The COMEX and the LBMA will continue to trade paper contracts. They will continue to blink red and green lights. But they will be trading a ghost. The underlying asset will have migrated to a different hemisphere. The miners have realized that the paper price is a lie, and they are no longer willing to subsidize the lie with their sweat and capital. By pivoting to Asia, the miners are effectively enforcing the Basel IV rules for the regulators. They are starving the banks of the collateral they need to survive the night. The supply cliff is here. The pipe has been cut. The water is still flowing out of the tap in London, but the reservoir behind it is dry. Part 7. We have arrived at the moment of kinetic release. This is the chapter where the laws of physics take revenge on the laws of financial manipulation. In the trading world, they call it a short squeeze. But what is coming in the first 48 hours of 2026 is something far more violent. It is a gamma recoil. Imagine holding a beach ball underwater. You push it down with all your strength. You use every muscle to keep it submerged. That is what the Western banks have been doing for 40 years. They have spent billions in leverage to hold the price of silver down against the buoyant force of a global shortage. But last night, China drained the water out of the pool. When the markets fully reopen on January 2nd, after the Basel IV deadline has passed and the strategic retention order is public knowledge, the banks are going to lose their grip. Here is the math that terrifies the risk desks at JP Morgan and Citibank. To suppress the price, the banks have to be net short. They have to sell contracts they don't have. This means that at the absolute bottom of this smokescreen crash, and the $75 or $80 level we are seeing now, they are holding their maximum short exposure. As the price bounces off the bottom, driven by the industrial panic bid, Part 5, the banks are instantly underwater. Their losses aren't linear, they are exponential. And here's the trap they built for themselves. To stop the bleeding, they must buy. But who are they buying from? They can't buy from the miners. The miners have sent their metal to Shanghai. They can't buy from the retail public. The dealers have locked the doors. They can't buy from the East. The East has closed the export gate. This creates a gamma squeeze. As the price rises, the market makers who sold put options to the hedge funds are forced by their own risk models to buy futures contracts to hedge their exposure. They become forced buyers in a market with zero sellers. They will be chasing a ghost. The algorithms that smashed the price yesterday are programmed to flip. Once silver crosses the key technical resistance levels, likely reclaiming the $90 level, the Excel bots shut off and the SPY bots turn on. But this time, they will be bidding into a vacuum. We are predicting a gap-up event on Friday morning. The price won't drift up. It will teleport. You might go to bed seeing silver at $80 and wake up to see it at $120. The Western banks tried to create a technical breakdown to save themselves from Basel IV. Instead, they have loaded the slingshot for the greatest technical breakout of the decade. The crash was the pullback. The release is next, and the target is no longer the old high. The momentum from this recoil has the mathematical energy to push us straight through to numbers that sound ridiculous today but will look cheap next week. The banks built a trap, walked inside, and handed the key to China. Now, the spring is uncoiling. We have reached the end of this investigation. We have analyzed the China corner. We have exposed the shadow warehouses. We have tracked the miner revolt and the industrial panic. The yellow tape has been wrapped around the crime scene. The evidence is conclusive. The price action you're seeing right now, the red candles, the volatility, the fear, is not a market correction. It is a getaway car. It is a desperate attempt by a cornered Western cartel to smash the window, grab the last few ounces of retail liquidity, and flee before the reality of the empty vault becomes public knowledge. Now, the only variable left in this equation is you. You are standing on the tracks of history. For 50 years, the silver market has been a rigged casino where the house always wins. They printed paper to suppress the price. They convinced you that an ounce of silver was worth $20, then $30, then $50. But while you slept last night, the casino went bankrupt. The house has been cleaned out by a player bigger than them. The trap is set. The algorithm is live. The banks are counting on your fear. They are counting on you looking at your phone, seeing a rigged drop, and panic selling your future to save your present. Do not give them that satisfaction. Here is your final briefing for the start of 2026. 1. Ignore the screen. The price you see on the COMEX is a phantom price. It is the price of a paper promise that is currently being defaulted on. It is not the price of metal. If you sell at that price, you are donating your wealth to the enemy. 2. Watch the spread. The signal is not the spot price, it is the disconnect. If spot is $80, but you can't buy an ounce for less than $120, the price is $120. The disconnect is the market screaming that the paper era is over. 3. Hold the line. The moment the new year begins, the moment the Basel IV rules lock into place and the Chinese export ban bites, the gamma squeeze begins. The transfer of wealth from those who hold paper to those who hold metal will be the largest in history. We have the intel. We see the data. The silver bomb has been detonated. The shockwave hasn't hit the mainstream news yet, but it will. You have been warned. The vault is empty. The East has the metal. The West has the debt. And the only thing standing between the banks and total collapse is their ability to trick you one last time. Secure your stack. Ignore the noise. Let them burn in the trap they built for you. Subscribe to the channel. Turn on the notifications. We will be live when the markets reopen to track the explosion. The heist is over. The panic is next. Class dismissed.